Hey everyone, good afternoon to you. My name is Brent Moore. It's time for managing an options portfolio. I'm glad you're here. Today, I just want to go through a whole bunch of different potential trade varieties and strategies and discuss exiting these different strategies. Some of them we'll get through, some of them will decide to exit, some of them will decide to hang on. We're going to do that in just a minute. But before I do so, I'm joined by Mr. Mike Fairborn, who's helping me out in the chat. So as you have questions, feel free to type in those questions in the chat box. Between Mike and myself, we'll do our best to help you out on those. Mike's a good friend and a longtime colleague, and glad to have him here. And I'm glad to have you here, whether you're watching live or on a recording. You can follow us on X at Mike Fairborn CS, at Brent Moore CS for additional content throughout the day. There we go. Let's talk about some other important stuff, some disclosures before we get into the main content here. Options do carry a high level of risk and are not suitable for all investors. And the information we're going to go through today is for general informational purposes only, and shouldn't be considered an individual recommendation or endorsement of any particular security, strategy, or chart type. The paper money application, this paper money software application that we're going to be using here, well, that is for educational purposes only. It is a great tool for you to try out some stuff, the paper money application, but these are not recommendations. All investing involves risk, including risk of loss. So let's see. All investing involves risk, including loss of principal, and past performance of any security or strategy does not guarantee future results or success. And there we go. I think we got it. I think those are the disclosures I need to go through. So let's go through. Here is, well, let's start with the S&P 500. That's how I normally start things off. And then we'll go through and look at some individual trades in the account. You know, the market has had a tumble. Looks like we have had a meaningful bounce here. This is probably a positive day because we had a low here. Is this a higher low? We went up, came down. This would be yesterday. And this would be a little close above the high of the low day. Now, here's the thing. We have today's Fed day at 2 o'clock Eastern time. So that's what, 2 hours from now? We have a Fed rate decision. Most likely, it seems like everybody thinks they're probably not going to make any changes, but half hour later, Chairman Powell is going to be talking in the market, and that can certainly affect things. So we'll see if this holds up. If we were to look at this chart and try and decide, let's say we're trying to decide, you know, am I more bullish or bearish on the market? I think one thing you could look at right now is you could throw on like a 200-day moving average. If we throw on that 200-day moving average, let me just throw that on there. We'll go 200. That's going to give us an area of potential resistance there. So we'll see if we can make our way back up through that. I'm not sure if this, or if we're just going to drive the market down right now. If we had a lower, obviously a key level right now is our previous low right down there. Okay. So that's obviously going to help determine the fortune of trades that we have. We have some bullish trades. We have some bearish trades. And I'm planning on going through some today. So I'm just going to kind of go in order here and talk about some management rules. But as we talk about these management rules, I'll start with short verticals. As we talk about management rules, here's what I want you to think about for any trade. Doesn't matter what type of trade you're going to do. There's kind of 3 overriding rules here in terms of management. I want you to consider. I want you to consider exits if trade goes against you. Okay, you should have this in mind before you ever enter the trade. Exits if trade goes for you, in other words, it goes the direction you want it to go. And then what if the exit if the trade goes nowhere? Okay, maybe not nowhere, but just really isn't moving for you or against you. Is there some sort of time exit? Okay, is there some sort of time exit we're going to use? So when we talk about these exits, one exit is going to be, in terms of that time exit, is going to be often for, say, short verticals. An example would be we're going to exit if about a week till expiration, something like that, or less than 10 days to expiration. So let's just kind of take a look at that. Here I have a short vertical on the Russell 2000, okay? And how are things going on this? Well, look, I have a PL open column, and we can see this particular trade is doing fairly well. So that's great. I have a PL percentage column as well. Let me just see if I can make these a little bit bigger here. And you can see, hey, this trade is going fairly well. So, but one thing is this, we got 9 days to go to expiration. Now, I could certainly hold this a few more days if we wanted to, but really we've made 62% here on this. So I'm just going to take the gain that we have on this. And so to close this out, what I'm going to do here, and this is, these aren't recommendations, of course, these are just example management, but the first example management rule principle I want to talk to you about is this, exit with a time if we're getting closer to expiration. So I'm going to right click on this. I'm going to create a closing order. I'm going to look to buy this back. When I put in that order to buy it back, now I want you to notice something. There's a mid price and there's a natural price. On spread trades, it's going to default to put it in at the mid price, right there. But the fact of the matter is, if I click on confirm and send right now, it is probably not going to fill me, either on paper money or in real life, if I have this in at the mid price. Now, it doesn't mean if I wait a little while, the price may bounce around and we may get filled. So if I want to get filled right away, I may want to move that up off the mid price, between the mid price and the natural price. That would increase the chances of us getting filled on that trade. So that is precisely what I'm going to do. I'm going to move this up a little bit and see if we can get filled out. Now, I'm not necessarily going to go to the natural price because I don't want to pay any more than I have to get out of this trade. I'm going to click on confirm and send, and I'm going to send that trade, okay? And it just filled. So we are out. We made a little profit on that Russell trade. But look, we've got a couple others. What about Disney? Look, we have a Disney trade on here, and this one is not going so well. We're down on this trade, but we still got a month to go till expiration. So what other rules are going to govern what we do, in addition to the idea of we're going to get out if we're less than 10 days to expiration? Well, we're going to also probably either exit at a stop loss that we put in at the beginning of the trade, or we may exit if there is a technical breakdown. In other words, when I say technical breakdown, if it's a bullish trade and the chart just turns really south bearish, or if it's a bearish trade, something goes up north, goes very positive, or maybe it's a trade, it's a neutral type trade, then if it goes either higher or lower significantly, not a little bit, obviously it's going to bounce around a little bit, then that would be a reason to exit as well. Or if it's a trade where we want huge volatility, If that stock just kind of languishes sideways, then we may do the time exit at some point. But let's take a look at Disney. Disney, you can see we have a stop on this of some sort. Now, it's not protecting us totally. I mean, we're down $71. Let's just look at this. We have a stop here, a 323 stop, a 323 stop. Currently, the value on this is, let's see, the initial, it's not giving me that initial trade price there, but it's going to be the difference between those. About 220 is the current value on this right now. So we haven't been stopped out there, but we do have a stop. Now, the other exit I mentioned is, what if we have a technical breakdown on this? Is this a bullish trade or a bearish trade? This is a bearish trade. This is a short call vertical. We want the stock ideally to stay below that $100 level, but we want Disney to be bearish. Well, let's take a look at Disney. So here's Disney. So you can see what we have here. It's a trade we were planning on it being bearish. We just had a little retracement. Is this a flag, or is this truly just a trend reversal? Okay. And so we have a stop. And now this stop, as it's showing on the screen, isn't necessarily exactly where this is going to get out. Remember, that stop was based on the option price. This right here is the stock price. We don't know exactly where the option price is going to be when the stock goes up here, or where the stock is going to be if the option price hits our stop. So this is just kind of giving you, an idea maybe, but we don't have to wait for the stop. But right now, I'm expecting maybe this will bounce. Maybe this is a resistance that will bounce off of. Maybe the gap will be a resistance. So I'm going to give this a little bit more time. And for that reason, in this case, in this example, in this class, we're going to say, let's just hold on to this a little bit longer for our class purposes here. Okay, I'm hoping that's making sense. Let's go to another short vertical. Now, by the way, this is a group I have categorized as short verticals or a short iron condor. A short iron condor, we would use these same principles. I don't have any right now. Yeah, this is just a vertical here. So AbbVie is, let's just see what we got here. We have a short put vertical. So this is a bullish trade. Okay, this is a bullish trade. This one we're up a little bit on in this paper trade. We're up a little bit. So we know our stop probably isn't likely to get hit. Remember, if it goes south, we have the stop that we're going to use, or a technical breakdown. Well, it's not doing that. We're making some money on this. Time exit, we're not at that time exit, but we may also decide to get out if we've made 75 or 80% on this trade. That's another rule that we may use. And in this case, we've made about 19%. So we're not there anyway, but let me just add that as one of our rules there. And this is, we're going to exit if hit, I'll put 80%, but remember, that's just for this class. Your individual rules may be different, absolutely. 80% gain. Okay, and we can also put a target price of some sort on there to automate that gain. That's no problem at all here. In fact, on AbbVie, we have an exit. Well, let's look. Let's click on that. Oh, actually, it's not going to let me do that from there. Let me right click. Let me just do this. I'm not going to actually cancel the order, but I want to look at this order here. So we have an exit if AbbVie marks less than or equal to 204 here on that. So that's a stop, but we could also put in a target. We could say, we could put in a target for an 80% gain. We could say if AbbVie crosses above the 215 level or something like that, we can get out. But we don't have that in this particular case. So there's some rules, but keep in mind, all these rules are in line, are going to the initial three rules to to rule them all. In other words, this is the three principles that we're talking about here. Three guidelines, if you will, to think about any type of trade. Exit. What are you going to do if this goes south? What if it goes north? What if it goes sideways? That's kind of the thought there. So there's short verticals. Let's talk about a different type of trade. Actually, let's go to long verticals because the rules are going to be probably fairly similar on our long verticals and our short verticals. Now, here's my long verticals. I have a long vertical on Apple. Apple we're doing quite well on, actually. We've made 129%. So the same rule that we mentioned over here before, if you hit an 80% gain, that may govern our rule here. We still have time, still 16 days. There's no urgency from that perspective. Obviously, it's not going south on us because we're making pretty good money. But there's the time to just, if you've made good money, you may consider just exiting out of that trade earlier and not letting it potentially go against us. So what I'm going to do here is, and if we wanted to, of course, we could look at that chart on Apple. Let me go. Let's go and let me just close this down. And so this is a long put vertical, 235, 225 put vertical. Oh, I did my symbol wrong. 235, 225. So we want the stock to stay below here. Now we can stick with this, but we've made most of what we can potentially make on this. And maybe this is, if we get a bounce in the market, maybe Chairman Powell says something today that gives the market a huge bounce or something like that, or who knows, then this could easily turn against us. We're just going to take our profits for this purpose here. Now, question from Jay Bass. Is this webcast watchable via replay? Yes, this webcast will be archived. It should be up later today, barring some unforeseen technical issue or something like that. Usually just a couple hours after this finishes, it will be up in the archives here on this. And if you're wondering, where do you get these archives? Go to the Trader Talks channel on Schwab. And you can go to the playlist for this class and you can see this session after it gets posted or past sessions as well. Can you place a trailing stop on a vertical? Question from Beauty at its best. Yes, you can place a trailing stop on a vertical. It's a little bit unusual, not a common thing to do, but you certainly could do that. If I wanted to place a trailing stop on this, what I would do is, I will close this out in a sec, but what I could do is I could right-click on this, I could create a closing order, and this is going to be an order to sell it out, okay? So this is the order as it is. I could go trail stop if I wanted to, and I could say, look, I'm going to go here, and I'm going to make that a percentage trail stop, and go, sorry, this is kind of scrunched down here. Why am I not getting my fields that I want here? Not sure. Oh, there we go. It was just scrunched down right there. Okay. That's what I want. And I could say, oh, you know, I've already made a lot, but I want to put a 20% trailing stop on this. And of course, that would be, if you did, that would be good till canceled. Now, trail stop or non-trail stop, stops aren't guaranteed to get us out exactly where we want. So just keep that in mind there. So, but yeah, you could do that. You could absolutely do that. I don't see anything wrong with that. In this case, though, I'm just going to take our profit. So I'm going to right-click on this. I'm going to create a closing order. I'm going to sell out of this. Again, we have that mid-price issue. I'm going to move it a little off the mid and see if we can get filled, confirm and send, and then I'm going to send that order to sell out of it. And now we're at, you know, we realized a little profit on that. Okay, so there you go, long verticals. Okay, so the long vertical trades management is probably going to be pretty similar on long verticals versus short verticals. As you get close to expiration, say a week to go, less than 10 days, somewhere in that ballpark, depending on your rules, and these are just the rules we're using in this class, then that may, you're going to probably have that in mind. That wasn't the case there. There we had hit a gain that was actually beyond the 80% we could have done. We could have done a stop loss, and we could have looked and see if there's a technical breakout down. All of these are going to apply to long verticals just as they are short verticals. Now, going to an entirely different type of trade here is long single options. Now, something in particular about these long single options here right now is all three of these I put in yesterday. These were all three of these trades were entered yesterday. So, so they haven't had much time to do anything. I think we're losing on all of them. Are we? We're losing on all of them right now. But we just put them in, so we're going to give them some time to work here. Another thing on these is these are a little bit unusual in these long single options. I teach a long options webcast on Tuesdays. And these three in particular, when we traded these, we did them all out of the money. What does that mean? Well, look, the stock's at 105. The put price is at 100. Let me do a call one. The stock is at 163. The strike price is at 170. I did these out of the money. Same thing is true for General Motors, which is not the typical way we're doing these trades. But if it is something that is of interest to you, I did a class on this yesterday. I'm going to put a link in the chat if you're interested in watching that class. The class is called High Potential, Low Probability. That's what it's titled. Typically, when we're doing these out of the money, they're a little bit more of an aggressive type long option trade. So just realize this is not kind of what is probably going to be most common for our long options, but it is there. If you're watching on a recording and you don't see the link in the chat, just go to the playlist for long options. And on March 18th, 2025, it's called High Potential, Low Probability if you want to review that webcast. But regardless, the rules are still good. We're still going to use rules. We're still going to have exit rules on these. And so maybe we're going to have an exit rule, and the exit rule is going to be if we hit a gain. And maybe that's an 80% gain. Maybe that's a 50% gain on long options, perhaps. It kind of depends. But one thing I want you to distinguish on these is this. There are long options. Know your time frame here on your long options. Know your time frame. In other words, if it's a swing trade, a shorter term trade, then you're likely going to be less patient with it. You're going to be a little quicker to get out, and a little quicker to get out if it goes against you, and probably a little quicker to get out if it goes your direction. So this is more of a swing trade, more of a shorter term trade. Same thing, we have 29 days to go to expiration, 23 days to go to expiration. But if you look at Johnson & Johnson, 58 days to go. That was intended to be more of a trend trade. So in terms of that gain, as long as the stock is continuing to go up, as long as the option is going our way, we may stick with that and not necessarily get out if we hit a 50% gain or something above that. Okay? But let's go back to this one. This is more of a swing trade. Yeah, we're down 17% on this. Now you may be going 17%. That's, I don't like that. Well, yeah, I understand you don't like that, but that's the nature of the beast. This is a long option. It's a more speculative trade, and we're only one day into the trade here. We're going to give this some time. This is a bearish trade on AMD. Let's just look at AMD. Our expectation is, from a technical standpoint, is that this trend is going to continue, and this is just a bear flag, and it's going to bounce down from here. That expectation may not happen. It may not come to fruition. That's okay, but we're going to give it some time on there. So in terms of rules, our time exit on this, yeah, we're going to get out at a certain point, but 1 day is not long enough on that. If it's not going anywhere for a week, in other words, if I'm expecting this to bounce down and it doesn't bounce down and we're a week out or 2 weeks out, then it's probably just not going to doing what we're expecting it to do, and we may get out at that point. So on a long option, okay, let me just put this down as a rule. On a long option, if doing nothing, exit. Why is that? Because on long options, time decay works against you. This is a theta negative trade. All of these long options are theta negative trades. Short verticals, if they're out of the money, they're not. They're actually theta positive. Time decay is helping you out. So if the stock just kind of goes nowhere, that is great. Not so much here, okay? So we're going to be less patient in general on long options than we are going to be on short options or short verticals. Okay, so that's going to be an exit there. But we'll get out. Now, let's say, theta is not so great that if the stock is going really strongly your direction and the option is going very far your way, it's going to kill you necessarily. Remember, there's kind of three principal things that we talk about in this webcast that are affecting that option price. One is the stock price, P, stock price. 2 is time decay, or theta. And 3 is implied volatility. If the stock is moving significantly in your direction, right here, that's the P, that's going to tend to dominate these others. So we may hold on to this, but at the end of the trade, what we don't want to have happen is well, I shouldn't say we don't want, you think about it if you want. If you want to be exercised, you can, but realize if this is in the money at expiration, then you will be auto-exercised on this. So probably most traders that's not their goal here on this. So very often we'll get out, certainly, the day before expiration at least. That's different. There's no early assignment or early exercise on these. It's you control it since it's a long option. On short options, we said we're going to get out with a week to go before expiration or so. That's going to help to minimize, hopefully, the risk of early assignment, even though it is still there. Okay? So there we go. Let me just kind of see if there's any questions to address on this, and then let's get to management of these, and then we'll move forward. Okay, let's go. I hit it when that happens. Perhaps risk reward adjustments found raising stop loss to decrease the risk amount. Yeah, that's a good comment that George made there, and that is, there was a question on the trailing stop. You can certainly do that. You can also, in addition to trailing stop, one of the benefits of a trail stop is it moves up as the trade goes in your direction. But whether it moves up or down, you can tighten up that stop at particular times if you want. There's certainly no problem on that. That's a great thing there, okay? All right, let's go and let's look at these. So we've got AMD, and we're just in the trade. We've only been in it a day. We said, yeah, we're losing money, but we're going to give it some time. This is a bearish trade, so we're just going to stick with it. Okay. We have a stop loss on there, by the way, too. Okay. General Motors, I think it's most the same story here. We're down a little bit. GM, this is a long put. Let's just take a look. Remember, if there's a technical breakdown, then it's not going to be, then we'll probably get out. where would the technical breakdown be on this? Well, I think when we got in, we were looking at this and saying, this is a potential resistance level. Every stock may have a different, what you consider to be a different technical breakdown. We also had this trend line, okay? So if we're breaking above there, so if we go up here, that's going to be our technical breakdown on this one, probably, for in this case. All right? So in this case, we're going to stick with it, though. And then our last one is Johnson & Johnson, which is more of a trend trade. We're down a little bit on this. Again, we're going to stick with this a little bit more. Now, on the trend trade, the technical breakdown we may be a little slower on that. Sorry, it was Johnson & Johnson. Okay. So let's do J and J. And just a reminder, these long options, long calls, long puts are lower probability trades typically, potentially higher reward trades, but they are a little more speculative in that manner. What would be a breakdown? What would be a technical breakdown on this one? Well, probably getting lower low in this case. So here's our latest low. General trend was kind of this. Okay, there's kind of our general trend. But if we're going down here, which is probably kind of near our stop, I'm guessing, then that's going to be where we're going to look to get out there. Okay. All right, let's move on. So I'm going to stick, bottom line, along single options, we're going to stick with each of those. We already did long verticals. Let's talk about, I have this category, calendars, diagonals, butterflies, which are all kind of neutral-ish type trades here. What do we have on Alibaba? This is a butterfly spread, okay? Contract in the money. It's a long contract, okay? It's a long contract. But going back to our rules, usually these we're going to look to exit about a week to go before expiration. Here we're 2 days to go to expiration. We've lost a little bit. We're down $43, not the end of the world on this, but we're going to look to get out of this trade right now, okay? So I'm going to right click on this. I'm going to close this just for time's sake here. And we're going to look to get out of this trade here, okay? Confirm and send. There's our time exit on that. We're out of Alibaba. Okay, let's go. And I think we have a butterfly here too. Butterfly on SPX. I've got 9 days to go till expiration. So we're starting to get in that time frame where we may look to get out on this. We're up a little bit on this. If you were concerned about maybe extra market movement because of the Fed announcement or something like that, you may just get out from that. But in this case, 9 days, we can certainly look to get out. We're under 10 days. We could also, you could also hold off a couple days and see. You could wait and see on that if you want. Pfizer, though, is not a butterfly. This is a calendar spread. Different expiration dates, same strike, that is a calendar spread. Now, what I want to mention to you on this is, when you're looking at calendars, you can look to exit, you can look to stay with it, of course. You can look to just exit it, or you can look to roll. Very often on rolling, what you'll do is you'll take the short contract. That's going to be the one that's going to expire first here on this, okay? March 28th. And you can buy it back and sell a date, which is sell a contract, same strike perhaps, that is closer to the long contract, but not there. But that really probably applies more if there's a bigger gap between these two. In this case, there's a 2-week difference between our long strikes and our short strikes. Only a 2-week difference here. So to roll, I mean, I could roll to maybe April 4th, I think would be the date, if I wanted to. But in this case, these are close enough that we may not consider rolling in this class on this one right now because of that. I'm going to let this sit just a little bit longer. Again, we're in this time period where we can roll this. One challenge with calendar spreads, probably true with butterflies as well, but more so even to calendars, is they just take time. They're kind of slow moving trades, and we're just kind of waiting for the time decay to help us out on that. So I know we're up 22 bucks, which isn't much on this. I'm going to let this sit just a little bit longer, but certainly 9 days, less than 10 days, you could get out. Certainly, if we were less than a week, we would look to probably exit the whole shebang there just because those dates are close enough to one another. Okay? All right, now let me just address the question. Someone said lower probability, didn't know that. Yeah, I was referring to long options when I said it. Remember, long options have negative theta. Time decay works against you. So if you think about an option, let's say we do a call option, okay? The stock can go up. That'd be great. That's wonderful. The stock can go sideways. I mean, obviously this is a simplification, or it can go down. Think about the three directions here. That's great if it goes up, but if it goes down, it's not so good. And if it goes sideways, or mostly sideways, just if you have that negative theta with long options, that's working against you. That's why I'm calling that a lower probability trade typically on that. Okay. Beauty at its best says, is there a difference between these weekly options and the normal monthly options? Well, the difference is the expiration date is really it. Now, practically, one difference is often you'll find better liquidity in the monthly options than the weekly options. Often you'll find more strikes in the weekly options versus strikes available in the weekly options versus the monthly options. Not always the case. But in terms of practical trading, it doesn't make that big in terms of the rules of how they work, it's the same there. Okay? Okay, let's move on. Let's go on. So I have long stock. And this isn't managing options portfolio class, so I'm not going to talk about managing the long stock. These are typically longer term trades here that we have in here. But I do have one option in here. And this is a hedge that we put on a while ago. We put it on the 19th. So what's that? A month ago. We put this hedge on, kind of worrying about the market going down. And certainly, this has done what it was intended to do, and that is help us if the market went down. We didn't know the market was going to go down, but it did go down. And so the question becomes, when do we exit these hedges? Certainly, we're going to exit before expiration. Okay. We're also going to exit. In fact, let me do this. We'll also probably exit. Now, the hedge is a long option, so time decay is working against us. But again, time decay isn't the biggest factor. We can keep it on, and we can pay the price of a little theta. That's not a problem if it's giving us what we want. So let's just say this. For a hedge, when a need for hedge passes. Okay, now you may say, well, there's always going to be a need for a hedge. But hedges probably aren't going to be a permanent part of your portfolio, partially because of that time decay element. But if there's a particular time of uncertainty, maybe you're worried about, this conversation with tariffs or something like that. Maybe it's a geopolitical event. Maybe it's a government shutdown or something like that you're concerned about, or an earnings. Then you leave on that hedge for as long as you feel necessary in that case. So I'm going to leave that on in this case because I think there's still enough questions in the market right now that I think it's worth leaving on for at least for another week. We'll probably address this again next week on that. Okay, so there's that. And we have one more category here. And this one is this. I just have it unallocated because there's a lot of different trades. 3 of these trades I put on are a little bit of a more unusual trade, and it's one I did in my last week's advanced options class, and that is these are long iron condors. Okay, now I know you guys have heard of long iron condors, but a long iron condor is just kind of it's not the short iron condor that you're used to. So I put on 3 of these. So instead of a short call vertical and a short put vertical, it's a long call vertical and a long put vertical. And so what our goal is on these is a play on volatility. We want the stock to move a lot, basically. And you can see, well, they're not really moving that much right now, to be honest. Where Abbott, we're down $28, down $30, up $7 or whatever on those 3. Those 3 are long. The Tesla's a different trade. Those 3 are long iron condors. So they've been on a few days. As long as you think this is a trade for volatility, here's another kind of exit rule. For volatility trades, you need to give it time for volatility to work, okay? Our plan wasn't, we hoped we were going to see great volatility in the next few days when we did this trade, but realistically, you got to give it a little time to work here on this. So for that reason, we still have time to expire, 23 days to go to expiration. On those volatility trades, you may just decide to stick with them a little longer. So that is true for Abbott. That is true for NVIDIA. I mean, what you can do is you can look at Abbott and say, where's our current price on Abbott? The current stock is about 127, roughly. Our long strikes are 134 and 120, right kind of in the middle. So in terms of volatility, this has basically gone nowhere on this. So we didn't get volatility. NVIDIA, the current price is about 118. Strikes 135, 110, maybe a little bit closer to the put side, but again, we're kind of in the middle. And you can see that here on these. There was Abbott, I think, was one that we had. We put it on, and from that time, we've basically gone sideways. With NVIDIA, we put it on, and we kind of went up and then went back down. So we're back where we were. That's a challenge. The third one has moved a little bit more. Visa. Current price is about 338. Where's our long strikes? 340 and 320. So this has moved up towards our 340. So this side is doing pretty well. This side not so well here. If we're convinced that Visa is doing a turnaround, and this isn't just a volatility trade, if I want to turn this into just like a bullish trade, I could get out of the put side of that equation there. And so there we go. And you can see that. And George said you could, if you pull up implied volatility on these, you can probably see that. Yeah, that's probably true here. And I'll just quickly do that. A good suggestion there. What you see is, you see how that implied volatility is mellowing out there? Yeah, you kind of see that. That's your implied volatility there. Now, I'm about out of time. Let me just quickly discuss one last guy here. This is another volatility play, but unlike the long iron condor, this is just a long straddle. And what are we looking for? We're looking for a movement on Tesla. Tesla was a high implied volatility trade, and our time decay, our drop in implied volatility has probably hurt us on that. Tesla, the last few days, has been more sideways, and that's hurting us as well. I'm going to stick with this right now because I'm going to stick with that volatility play on that. We still got 29 days to go. So let me just sum up here as we wrap up. For any trade, also consider, I'm not going to add this as a rule, but also consider the effective time decay, whether it's helping you or hurting you on your trade. If it is helping you, if you're theta positive, you're more likely to stick with that trade. If time decay is hurting you, you're probably quicker to exit that trade, but you need to think through the totality of it. On some of these volatility plays, you just got to accept there's some time decay working against you on that. Remember, have an exit if the trade goes against you. Consider your exits if the trade goes for you. Consider the exits if your trade is just kind of languishing and going nowhere. I want to thank you for joining me today, everybody. And I want to thank Mike for helping me out in the chat. Coming up, we have trading price patterns. That's at the top of the hour. Please remember to subscribe to the Trader Talks channel and follow Mike and I on X at Brent Moore CS, at Mike Fairborn CS. Everybody have a great rest of the day. Bye-bye, everybody.